Here's what's happening in the stock market today. We got non-farm jobs payrolls come in and a little hotter than expected when you look at the data from a few months back. 143,000 was the print for this month. The previous 2 months revised up an extra 100,000, which means effectively we got 243 today versus what was printed already. This is a fairly strong jobs data report. Despite notwithstanding, we only printed 143 for this month. The jobs market is continuing forward. And I'm going to break down what's going on, what is driving the jobs market, and what might actually pause it. Number 2 point to look at, annual revisions came in. And when you look at the chart, it's kind of like, whoa, what just happened there? Because we saw a big spike up in total number of individuals considered in the payrolls and those working, but the unemployment rate fell. Now, what's going on in the stock market today? The stock market today is moving downward, as one would expect, given the fact that interest rates are moving right back upward. And we got a little bit of a reprieve from some of the kerfuffle coming out of Washington, D.C., a little bit of being put at ease with concerns about what could happen with policy shifts coming out of Washington, D.C. So we saw the 10-year, the long end of the interest rates moving lower when Trump was being quoted as not wanting to push the Federal Reserve to lower short-term interest rates. In fact, Trump did say that he felt that leaving rates at this level was appropriate at this time. We're probably, if there is no policy shifts coming forward, we're probably going to see short-term interest rates remain here. It would be tough to see them pop up a little bit higher, but I could see that working out. In the meantime, what happens if we get tariffs? This could force the hand of the Federal Reserve. Long end of the yield curve eased off. This pushed interest rates lower after we got this sort of calming effect from the quotes we got out of there. We still don't know what the policies are going to look like when it comes to tax cuts. I just saw an interview with Mike Johnson saying we definitely don't want to have the tax cuts be extended because of the problems with the deficits, but we will definitely extend the tax cuts. I think in the mid-sentence he realized what he was saying, that no matter what, these tax cuts are coming. No matter what, they're going to be very deficit detrimental. And that's what's pushing interest rates up higher on that regard. So let's break down the jobs data. What did I do with SQQQ ETF and TBT ETF? I've been consistent with how I'm playing economic data going into each one. Bought both of those going into today's number. Took a little bit of profits off of both of them. The SQQQ was, I made a couple pennies. It looks like I got out early. I chickened out, but my TBT ETF, which is the inverse bond ETF, that one did all right on that. Already took my profits. Going to go ahead and finish up these videos. That's it for the weekend. Let's jump in and I'll break down the data points for you. All right. Transitioning into this, I did just check the stock market today, and actually it is starting to sell off a little bit more. And I just believe that we've seen the highs that we will see for some time, that this bull market has run its course. One of the reasons why is lack of consistency. There is pure chaos coming out of Washington, D.C., and that is by design. They're signing executive orders left and right that are absurdly meaningless, zero efficacy whatsoever, only to create headlines, zero policy. So we're not looking at what other things they're doing. That's fine. Great. Those are the policies. How can I make money in the stock market? And if you want to make money in the stock market, you need to look at those things that are happening in Washington, D.C. for exactly what they are. Such as there was an executive order for a sovereign wealth fund. Great. Someone put a piece of paper in front of someone, and that someone signed that piece of paper. It has zero efficacy whatsoever. Because the President of the United States of America cannot just decide that he wants to start a sovereign wealth fund. The President of the United States of America could sign law. And then within that law, there would be aspects that the executive could choose, pick and choose, like, I think we should do this, I think we should do that. But the President of the United States of America cannot just decide, oh, that's it, we have a sovereign wealth fund. Based on what? He's hiding something. And if you've watched any of my previous videos, you know exactly what he's hiding, which is fine, great. It's all noise. But here's the thing. The stock market today, when you're looking at it, is down. What does the stock market not like? Noise. It loves consistency. We are not getting consistency. Because of that, we've seen the highs in the stock market. That's how you have to look at this. Fine. How can you make money in the stock market given what's going on in Washington, D.C.? And that's what you basically have to accept this is going to be. 4 years of woohoo. I made my money today. Here we're looking at non-farm payrolls. Again, the previous 2 months shot up an additional 100,000. And the thing is, this is the 3 months. This month and the previous 2 months. This month is preliminary. The previous 2 months will be revised. And when you look at the data, you can see that they put it in parentheses P for preliminary. The Bureau of Economic Analysis, Bureau of Labor Statistics, whoever may be putting out these data points, they simply don't have the information, 100% of the information all the time up front. So they'll get additional information, then revise the previous months. These past 2 previous months were revised up an extra 100,000. So although we printed 143 new non-farm payrolls, there was an additional 100,000 tacked onto that from previous that we did not realize. So that's how that plays out. Still, 143 is pretty solid. And given the previous 3 months, 4 or 5 months, when you look at that, you're looking at consistent job creation. For now, what's going on in Washington, D.C. with federal employees and all these things? On the one hand, the executive cannot do 99% of what he's trying to do. He's just making noise. Period. So I don't know what kind of shifts we're going to see with employment data based on going forward, whether or not some of these people do nibble on his offer that he cannot actually offer. Hey, listen, if you quit your job today, we'll pay you for the next 9 months. There is no law whatsoever that allows him to give that offer. But there are probably federal employees who sit there and say, fine, I'll take that. Unfortunately, as soon as they tenure their notice, they're not going to get 9 months worth of, there's nothing that supports that. But he might catch some people off guard. Great, awesome. So that would affect employment. Interestingly, government increases in employment were one of the reasons why job data went up. But this is from January. All right, moving forward. Again, civilian labor force, when I saw this, I was like, what? Revisions. The unemployment rate actually moved down slightly, and this is all an annual revision. This one's a pretty big revision, so we'll see these continued numbers moving forward. The civilian labor force, the number of employees in the civilian numbered employed within the civilian labor force in the green there, and then the subtraction of the blue minus the green, of course, is the unemployment rate. You're unemployed, but you are considered within the civilian labor force. So that revision was, to me, very eye-popping. I was like, what the? I had to read all the fine print. Annual revisions. Unemployment rate coming in slightly edging downward. We did have some everything that's going on with the East Coast with the hurricanes tearing through. We now will be considering West Coast with the fires, something like what? I don't know the actual number, but it's in the thousands of houses have been gone. That will affect employment. Let's see how that plays out. And that could push the unemployment rate up a little bit higher. Also, whatever's going on in Washington could continue to affect unemployment, pushing it upwards. So this would alleviate pressure on the Federal Reserve. My take on the tariffs, I've talked about this on several of my videos, they are happening, period. Okay, there's a stay of execution for 30 days. We're down, another 3, 4, 5 days? But they're still going to happen. Someone's going to get his pockets lined. Fine, great. Policy. How can I make money in the stock market? And that's what it boils down to. Here's a bigger look at the unemployment rate. The same chart, just a different time frame. This goes all the way back to the year 2000, January 2000, which we were in the dot-com era. And I know a lot of you guys were not even alive. Some of you guys probably weren't even alive. I've seen the number as to what who watches my videos. I see the ages. Most of you were like 10 to 15 and didn't really care about the dot-com bubble. But you can see the unemployment rate increasing after the dot-com bust. Then, of course, you see the financial crisis there, dead smack in the middle, and, of course, COVID. So the unemployment rate is elevated somewhat on a historical basis. Now, this is a percentage, and that's important to understand. But if it continues to move back lower, the Federal Reserve would have successfully raised interest rates upward, contained inflation, started lowering interest rates. Unemployment did not skyrocket. Unfortunately, however, at the same time, the Federal Reserve didn't exactly nail the landing with price growth. And then we get policy shifts. So this is going to be a day by day, week by week, month by month, year after year kind of look as to what's going to happen next and how can I make money in the stock market today. All right, this is what drives everything, money. When the rate of growth is increasing in money supply, you get to see employment growth. Employment growth comes from businesses borrowing money. Keep in mind, the Federal Reserve is reducing its balance sheet, but commercial banks are increasing their deposits via fractional banking, lending out money. And that's spurring economic growth. Although the Federal Reserve is reducing its balance sheet, commercial banks are making up the difference. And the rate of growth is increasing. We are above zero. But I have seen some charts, and I'm still trying to dig in and find the information that liquidity is starting to dry up a little bit. So we may see a lag with growth in the money supply, and we may see some pausing going on, which would be positive for price pressures. Those businesses go out, they hire people, those individuals, they get put to work, they start building things to move forward with manufacturing, which actually COVID, we saw a huge decline in manufacturing during the first portion of it when Trump was president. All through Biden's administration, we saw a big spike up in manufacturing. However, Trump has just basically signed away a whole bunch of presidential edicts, getting rid of a lot of those chunks of, the Tax and Inflation Reduction Act. So we'll see how that plays out in the manufacturing sector. In the meantime, those individuals that are being hired are spending money. That creates inflation. Looking at interest rates themselves, this is just going back, what is this? This is the 10-year yield going back about 2 months' time. You can see on the right-hand side there that generally speaking, we saw Trump basically said during an interview off the cuff, like he always does, that he felt that the Federal Reserve should have maintained interest rates where they were at that time. And the market took that as being that, so you're not going to pressure the Federal Reserve to reduce interest rates today. And I think this was reiterated by the new Treasury Secretary, actually. I can't really remember whose article I was reading when I saw that. Fine. So the belief is that short-term interest rates are appropriate where they are, and that the president is not going to try and strong-arm the Federal Reserve to move interest rates at this time. Let's see how it plays out. Inflation is starting to trend a little bit higher. This week coming, Wednesday, we get CPI data again. If we see a strong number there, forget about it. Here's a bigger look at the 10-year U.S. 10-year Treasury yield. Again, we're in the upper bounds. This goes back quite some time, all the way back into COVID's sort of range. Still, where we are at 4.5%, historically, if you go way back, this isn't very high. It's high relative to where we are now, but we have strong economic growth. So this makes sense that the U.S. 10-year Treasury yield would be where it is. The 10 is real decent sort of look point from the 2 to the 30. We still don't know what's going to happen with tariffs and how that will affect any stock market moves. SPY ETF, this is the 4-hour bar chart, and as you can see, SPY ETF has slid lower on the news from jobs reports today. I put on 2 trades. One of them is actually TBT ETF. I took the inverse. I got a comment on a video. I'm not sure if it was a video or a short on YouTube, and the individual thought that it was risky for me to take the angle that I'm taking, to buy TBT ETF. TBT ETF is the inverse to bonds. All right, it's not necessarily the inverse to TLT because they're different instruments, but they are inverses to each other, purely by coincidence. I bought into TBT ETF knowing that we'd get a hot number, it would spike up, TLT would move downward. I'm trying to protect what profits I have. So I took my profits out of my long TBT ETF and will be buying into TLT probably after Wednesday's number, because I think we'll probably see TLT move down even further when we get to inflation on Wednesday. And that's probably what I'm going to do, is cherry pick the bottom of TLT. So anytime we get economic data coming in, I'm buying that TBT, watching it spike up, take that profit, wait for TLT to settle down, then buy that for my long-term holdings. So basically I'm playing TBT to buy TLT. And I mentioned in that comment that I said to him, I said, this is just the strategy that I'm taking. His comment was, why don't you just buy TLT? And I don't think he meant anything nefarious, and neither did I with regards to it. I think it was just a matter of, maybe to me this isn't the way to do it. Okay, great. But this is the way I'm doing it, and it worked out today. Wednesday, I'm going to do exactly the same thing. And my position is simply this: keep buying TLT for a long-term move. The eventuality is bond yields will have to come down. I don't see them going up too much further. Here is TBT. So I bought in yesterday, midday. I think I got, I want to say 60. 34.60 is where I got in. I pulled out about 40 cents. I'll do this all day long. Any economic data point we got coming in over the course of the next couple of weeks, my expectation is that bond yields will spike as bond prices fall. TBT ETF is an inverse and therefore will spike higher in price because interest rates spike higher. That's how I'm playing it. One final trade that I had was SQQQ. Again, I took some profits on that pretty quick. I think I made like 12.5 cents. Not exactly a huge trade, but it was the inverse. SQQQ ETF is the inverse to the NASDAQ, or you could say QQQ ETF. So I took the inverse on that, knowing that bond yields will spike, bond prices will fall, stocks will fall. The initial move was modest. In fact, I think the absolute initial move was a spike higher in stocks overall, and then a slow process downward. I don't think we're going to get ugly going through the rest of the day. I think we're probably bottomed out at this point, and that the job market reiterates that We have a strong economy right now, maybe too strong for the current level of fiscal policy. But liquidity is starting to tighten up. So says an article that I looked at. It was a Yahoo Finance chart, actually, and they said, yeah, liquidity is starting to get a little tight. That, to me, sparked something where I sit there and say, okay, what do you mean by that? Because the chart itself wasn't exactly self-explanatory. And I want to ask the question, are we seeing a decline in the rate of growth of money supply? Are we seeing a decline in, from a liquidity standpoint, will this turn into a shrinking of economic growth from the money supply? So that's something I want to kind of take a look at. I've not seen that data point yet. I'll probably look at it over the weekend and try and find out what are these guys talking about. Regardless, make sure to hit that like and follow button. If you're looking for the written content on this, Substack link is in the description and at the end of this video. See you in the next video.